if you're going, my accountant or my fractional account says things look good, but my bank account says zero, and I don't know why, it's time to reach out. You laugh, but that happens way more, way more than you think.
This podcast contains the arguably witty banter of two friends, Skippy and Dougals, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Back with another hot episode of Skippy and Dougals Talk Investing. Before we get started, please rate and review the podcast. Follow us. We got Instagram at Skippy Dougals. We're going to do some listener mail today, and you can send us listener mail. Any comments, questions, thoughts you have, skippydougals@gmail.com. Let's hop into the episode. Skippy, what are we going to talk about today?
Yeah, three main topics. We're going to talk about Circle Internet Group, which is a crypto stablecoin that IPO'd.
Yes.
If you guys don't know. One from last week, actually 2 weeks back, when we talked about no taxes on tips and the fact that that passed 100 to 0. I'll tell you what that actually means, which for most people is absolutely nothing. This is kind of hilarious. Politics at its best. And then apparently 20-somethings, let's say all adults, are really struggling with adulting. And we're going to talk through some trends there before we go to listener mail. Okay. Circle, this is Dougals. We went through GameStop. We went through, I can't even remember, AMC. We went through all this garbage, this incredible garbage, where people are just out there speculating, literally throwing money in a fireplace. And then it happened again this week. So Circle, at the highest level, you might be able to do a better job articulating than this, is a crypto stablecoin. So what that means is if I send them $100, they might hold $20 of cash, $80 worth of U.S. treasuries or some other asset that's thought to be very, very safe. So basically, they're holding a bunch of cash and cash-like assets. And then the crypto trades all over the place. And when someone takes out the $100 that I put in, maybe I transfer it to someone, my friends in Mexico or my friends in Guatemala or my friends in Europe somewhere, they take it out. They have to actually pay out the $100 that I paid in. And so that's why the assets need to be largely liquid. So as a business, there's no huge upside here. What they're going to make is the spread, a tiny spread on interest of holding these supposedly safe assets. Correct? We could
It's a volume
add
play.
anything there?
It becomes a volume play at that point.
Sure.
Because you're making small amounts you need to make small amounts of money on large amounts of assets. That's
this company IPO'd this week. I believe they IPO'd $31 a share, right around there. Currently trading at $114 a share, which is 146 times 2024 earnings. Now, Dougals, you're right. What the market seems to be saying is, hey, stablecoins are going to be huge. Stablecoins are going to be 1,000 times what they are today. If you believe that investors are rational, and I personally believe that a bunch of people don't understand what crypto does, what Circle does, has heard of it before, thinks stablecoins will be big. By the way, there's a bunch of other stablecoin competitors, so stablecoins could be really big, and Circle could ultimately be worth $0 effectively.
I'm of two minds. The second mind, I'm going to address what you just described. The first mind is this. A friend of mine used to be CFO of Circle, and I just want to say congratulations. You hold a stock that just went up a whole bunch.
Me too. Sell it, please. Official investing advice.
Congratulations. So I'm going to say that. Okay, that aside, for this conversation, I think that there might be something a little bit more than what you're describing. I think that right now, there is even more so than, I'll call it 6 months ago, there is more of a bullishness around coins of any type. I think under this administration, coins, if you have coin that is attached to something, there's bullishness on what that's going to be able to do. And if you take stable coins in a macro, I think folks are saying that is a part of the market that, for what you were saying, it's going to be, well, whatever, 1,000 times what it is today. The part I'd push back on what you said is, I don't think it's quite as, you didn't use this word, but I'm going to use it. It's not quite as ignorant, I think, is what you stated. That doesn't mean that it's fully rational either. I'm not trying to say that, but I think that people are saying that coins under this administration are going to do things, or going to have more backing from the government than they would before. And there you go.
Okay. If I said ignorant, I misspoke. I don't mean
You
that.
did not say ignorant. You did not say that was my word, not yours.
Pure speculation, effectively gambling. No one is out there with a spreadsheet that says Circle is going to capture X percent of the stablecoin market. The stablecoin market is going to X many trillion. 3 people out of the tens of thousands of shareholders this week. Everyone else is betting on a trend. I just want to make sure I'm reading between the lines here, because you're implying so that when you say this administration is hot on coins, like besides stable coins, what are you talking about here?
Is that a real question? Okay. The Trump administration, Trump himself, prior to becoming president, he spoke at the Bitcoin conference last year during his campaign. While he's been in the administration, of course, I'm going to say can't, but he can't really fully get behind individual coins. However, he did hold a conference with some of the largest crypto investors in the world not too long ago. His family outside of the administration is going pretty deep into crypto, both internationally and in the US. He has DJT. So I'm just saying, like, the administration is all up in coins, anything.
Yeah. Well, no. So you're saying coins as a proxy for crypto. The funniest thing is this
not
is
pennies.
This is crypto in the old school legacy financial market.
Yes.
As a stock, and it's the least exciting, one of the least exciting cryptos there is, because it's simply like trying to be a dollar bill in the electronic world. This is crazy speculation. I stand by it.
Okay, that's fair. That's fair. I think we can agree to 87% agree and 13% disagree.
Go buy Visa and MasterCard, people. Do not buy Circle Internet Group unless, I don't know. Let's see what speculation. Wait, I don't short stocks, but man, I'd like to short this one if I just would. Anyway, should we keep it moving?
Yeah, let's go.
All right. Just last week, we talked, or a couple of weeks back, we talked about no taxes on tips. My official stance is this doesn't make any sense. If you're trying to give people that make less than $40,000 a tax break, or less than $60,000 or whatever your threshold is, just give them a tax break, right? New York Times broke it down, gave us some actual math. I think it's quality stuff, right? So we'll start with the simplest example. This one really hammers home my point.
And before you even get into that, what I'll say here is, with these kinds of calculations, there are all kinds of nuances. And we understand that. Not everything can always be included in everything, because different human beings have different circumstances. So I just want to put that out there. We understand that. But these calculations, to your point, I think are like directionally right. It's worth having the discussion around them. All right, go ahead. Sorry.
Douglas, these calculations are perfect. 1,000% perfect. To the penny.
Fair enough.
All right?
Fair enough.
To the penny. Okay. Bartender makes $18,000 in tips. I have no clue if these are real numbers or sorry, $18,000 in wages per year, $22,000 in tips. Okay. That would mean he's able to take a standard deduction. He or she is able to take a standard deduction of $16,000 plus the tips deduction of $22,000. Their total taxable income would only be $2,000. A salesperson who makes $40,000 a year, that's the same gross total income, only gets the $16,000 standard deduction. And what this ultimately means is the bartender would owe $200 in taxes for the year, and the salesperson would owe $2,600. So just because of the type of their profession, the way we continue to butcher our tax code, one person is going to owe $2,400 more in taxes, which is a decent sum of money on $40K.
Yeah.
Right.
And this gets to your point that if you're trying to save folks that of a certain income money, and you're using tips as a proxy for that, just skip the proxy if that's what we want to do, and instead say anyone that makes, in this example, $40,000 a year or less, you get to have a certain deduction or savings. This it's the kind of thing you were saying. This is the exact example. The retail salesperson versus the bartender in this example.
And the salesperson's tax bill is going to be 10 times the bartender's bill. It's very interesting to me. They go through all sorts. Yeah, go for it.
The next one I thought was even more interesting. That was saying effectively the more money you make, if you just take the tips point, the more money you make, the more this ends up benefiting you. Which the reason I found that to be even more interesting is because I think that's the opposite of what folks would want if you just had to lay it out in plain English. And so an example they give is the example of someone, blackjack dealer. You're a blackjack dealer. And if a blackjack dealer is making, because there's a lot of tips that go into blackjack dealers. So in this example, $40,000 in wages, $60,000 in tips. So you end up with $100,000 total income. That $60,000 ends up being a deduction. And so for them, instead of having to pay about $13,000 in income taxes, they'd end up having $2,600 in income taxes. Huge difference. Huge difference.
Yes.
Right? Someone is being tortured behind me. So like, it's pretty awesome. Yes. So in that example, but if you take someone like a hairdresser was who they compared that to. Hairdresser, $60,000 in wages, $10,500 in tips, so $70,500 total. Because they have fewer tips as a part of their income, they would end up owing $5,000 under this new policy in income taxes versus about $7,000 if they didn't. And then if you go even further, they show someone who is the lower end of like the waiter, like style, which it basically has almost no benefit at all. So the more money you make in this, the more benefit you have. That just isn't what it would seem like the policy is all about.
It's really bizarre when you actually look in the numbers. So like an Uber driver has zero tax burden today, will have zero tax burden tomorrow. It doesn't change the average Uber driver at all. The blackjack dealer just got a $10,000 raise. The hairdresser just got a $2,000 raise. The bartender just got a $2,000 raise. And everyone that doesn't get tips that makes similar salaries effectively got a pay cut.
Yeah,
it like just makes no sense. When you actually look, the talking point makes a ton of sense, right? No taxes on tips. This is great. It got 100 yes votes and 0 no votes. Looking at the actual math, which I know no one ever does, it just makes me frustrated. It's not fair. It's not close to fair.
The number of times I feel like that we have said the talking point makes a lot of sense, and when you look at it practically and look at the math, it makes 0 sense, is way too high. We need to calm down on this nonsense.
That's how the human brain works. I don't like this at all.
I know.
I'm like I said, frustrated at this nonsense. We need to move on, Douglas.
All right. You want to go on to the third topic?
Yeah. All right. So I find this incredibly fascinating. Here's my mini rant. Tell me if I'm right or wrong. Okay?
Wrong.
Perfect.
Okay. Next topic.
We're looking at Google search volume. It's a normalized figure, right? It's indexed from 0 to 100. And we start in 2010 and go to 2025. So a 15-year trend. And these are basic adulting things is the way to say it. Like how to do laundry, how to use a mop, how to use a washing machine, how to file taxes, how to set up a bank account, et cetera, et cetera. Okay. All of these trends are pretty significantly up and to the right. My belief here is that this is because people have stopped talking to people. They don't have friends. They have online friends. So you can't ask your friend how to use the washing machine. Am I crazy?
You're not. I don't think you're crazy. So let me say that. I do not think you're crazy. I don't know if that's the only reason this is, but I do think that that's a strong one. People turn to online before they turn to other humans. Or online humans before they turn to not offline humans, which are just humans. I do think that's the case.
That's a better way to say it. And it's less dramatic, right? So is it just that Google, now the AI, search engine, etc., has improved so much that it's just easier to talk to a computer than it is to talk to a person, even if you are regularly talking to people, even if you're out with friends 4 times a week? Is that all that's going on here?
I think so. The dramatic nature of the things that are on here, like, for example, how to put up a picture, is one that's on here. When you have things that feel so simple like that, I think it makes it feel more dramatic. But for example, for me, if I'm trying to do something with my sprinkler system in my house, it's more likely that I'm going to Google something first or look on YouTube first before I ask somebody. That's much more likely. And so even with these basic things, I think that I could see where someone would turn to online first.
Yes and no. Okay. How to change oil. I'm with you, right? You've never changed oil in your car. Google away, watch some YouTube. I'm with you. A question like how to use a credit card? Come on now. That is a ask the computer first because you've never seen what your parents or your siblings use a credit card. Like, is that hard?
This is one where I'm kind of like, was it really how to use a credit card? Like, until you just said that, I didn't realize when it said, I was thinking like how to get a credit card. Like I was thinking of something more along those lines. How to use, you just hand it to the person. All you do is hand it to the person.
And like, I'm also pretty fired up about how to set up bank account. It's like, I would hope when you get a bank account set up, I don't know, sometime between the age of 6 and 12, let's say 15 at the latest, but you should have some guidance. Like, Google should not be your trusted resource for how to set up a bank account. Also, how to use a mop is like, someone should teach you how to use a mop. You should have, like, you've never used a mop. You're like 27 years old. And then you're like, first of all, how to buy a mop. Apparently people can figure that out. But then how to use a mop, you don't know? Like,
I do also like how to use a hammer. That's another.
so bad. It makes no sense. Maybe the results are skewed. Maybe no one ever Googled how to use a hammer in 2010 because people had common sense. Or maybe this is all bots. I don't know.
Oh, okay. Maybe I am closer to where you were then.
All right, perfect.
Okay, should we go to listener mail?
Yeah, I'll let you kick us off and give the background there.
All right, well, first, let's hit that jingle.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doodle Show.
All right, so this piece of listener mail here, this comes from Greg. Thank you for sending this in. And the concept here, we could broaden it out, but I'll just give the more specific concept of what Greg says here. He goes, when you're starting a company, so you're a founder, startup, you are meant to be a jack of all trades, an athlete, or Jane of all trades, but an athlete of some sort. You come in, you got to do a lot of things on your own that aren't necessarily in your wheelhouse. You might be a great salesperson. You might be great at product or engineering, and like that's your spike, but you got to do a bunch of other things. Now, specifically what he's saying is one of those other things ends up being putting your finances together, closing your books, all the financial ish that comes up, building your first model. You got to do it as the founder. That's a thing that happens. When do you think about switching from you continuing to run that model to getting a professional to do that for you? Someone that's done this before, someone that understands what to look out for. That's the question that he raises and then also answers himself. This is what Greg does. He helps people to then get their books together, to do FP&A, right, forecast out. He does this for a living, and he's seen this problem time and time again, and so he wanted to raise it for us and say, here's how I think about it. That's the setup. Any other commentary before we dive in?
No, I thought this was good, but it's worth almost reiterating that point. This is specifically talking about when you bring in a professional in the startup world, right? And so there are, I call them mom and pop businesses, but there are businesses all over this country, small and medium-sized businesses that start at one employee or two and grow to 50 to 100 to 500 and on down the line. The calculus would be slightly different for those businesses than it would for this listener mail topic, but I thought this was really good. I liked the way that Greg talks about it and really answers this question of, gosh, like, how much can I do by myself without hurting the company? And then when do I have to raise my hand? Like you mentioned, the thing that's amazing about this is, as a startup founder, you have to run lean, and it should be a piece of pride for you to be like, I can do this. I can do the marketing. I can do the sales. I can do the finance. I can do the accounting. But you have to be very careful about carrying that too long, because it can get to the point where it really hurts you, and it really hurts you with future fundraising or general operational things. I work in a similar realm, right? And a lot of times when companies get profitable and they grow and they're 20 to 30 to 50 employees, the founders lose sight of how much their time is worth and how much new revenue they could bring in the door if they were out selling stuff. They should not be handling their accounting. If you're running a 35-person firm that's bringing in millions of dollars and is profitable, you just should not.
Fully agree. And so this is Greg at GTX Finance, by the way. And I agree with that point. I'm gonna broaden it a little bit, but to hit on what you just said, and maybe to one finer point when it has to do with this topic, is it's your cash flow. Like, what you're playing with is not just your time, which I'm going to hit on a point with your time, but it's also your cash flow. Where I personally ran into this was when I started a company many moons ago. I was the first back-end engineer. I'm not a coder, but taught myself how to code, built the back end of our website, and kept doing back end work, which that means it's all the code that actually goes to the servers for those that aren't in the coding world. I continue to code on the back end. It is not, by far, not my spike. Like by far not my spike, but it was a thing. Like I could do it when I went to go, we were like conferences and I was talking to people and they were like, oh man, you learn how to code and do this yourself. And like there was this point of pride that sat around it. The amount of time that I spent coding versus everything else that a CEO should be doing is like outrageous. And I learned that from the time perspective, as you were just saying. It's like, I should have been doing so many other things that could have helped the company be successful that were in my wheelhouse. When it comes to this, though, cash flow, don't play around with not knowing how your operations are impacting or not your cash flow. Don't play with it.
Well, so how do businesses go out of business? You run out of cash. It's the only
period.
Right?
Full stop.
Period. So Greg's answer to this complex question, I just want to hammer on it, is I think I'll actually read it. Once a company reaches the point they've graduated from ground floor financial modeling to operational financial modeling, it's probably time to hire a finance pro. I agree with that. Have no qualms with that. I think it's different for everyone else. What I'd say is another thing you could do is phone a friend who's an expert. Like you don't have to hire someone. You can have a conversation or two without hiring someone.
Wait, you mean Google it?
Absolutely not. Absolutely. Almost all founders are going to really struggle with revenue recognition techniques and cash-based accounting versus accrual-based accounting, etc. Right? If you are getting to a point where you're paying enough people and you don't understand and have some predictability with what your bank balances are going to be, it's time to reach out, right? If you're going, my accountant or my fractional accountant says things look good, but my bank account says 0, and I don't know why, it's time to reach out. You laugh, but that happens way more than you think.
If anything says that things are good, but your bank account balance is 0, the second half of that is the critical part. Yeah, I completely agree. And it's hard. Yeah. It's harder and more nuanced than people would give it credit for. It's really hard. And it's hard to do. And it's also easy on the other side. It's easy to trick yourself based on a model that doesn't map to your business, but that like you think it does. But that doesn't, for whatever reason, that the unknown unknowns to you as a founder, it's easy to trick yourself into thinking that the model's accurate when it doesn't capture some of the operational nuances. Too simple.
So personal story here. I had a startup company come to me earlier this year and asked me to build and run their financial models. And the person that came to me was actually not the founder of the company. He was one of their first large investors, right? And I went through their pro forma financial statements, and in my opinion, they were absolute garbage. And so I sat him down, explained why they're absolutely garbage. Explained the fact that they needed to raise way more capital than they were going to actually be successful. And I showed him real life models, and I told him exactly how it's going to be. And the investor said, "That's interesting. I never looked at the financial projections." The reason I'm telling you this is this happens more than people realize. A lot of times people are betting on an individual or a concept or an idea, or they want to brag about the check they wrote with their friends. But it ties back to Greg's point about when you have to be, when you're selling an idea versus when you're in operational financial land and you actually have to pay payroll. Two very different skill sets there.
Very, very, very. And sometimes it shouldn't, but sometimes finance feels like marketing feels. I agree with the same point with marketing, by the way, I'm going to say, is it feels like, oh, okay, I kind of get it, and I can go in Excel. It's like I can put together a model. Check. It's like I can go onto Facebook and like create an ad. I can come up with it. That doesn't mean that it's good. Like it doesn't, but it's easy to trick yourself in those circumstances. So agree with that. Thank you, Greg.
Thanks for the email, Greg. I hope we did it justice. And we'll link that in the show notes or the blog post that accompanies it for sure.
Absolutely. Well, anything else you want to hit on today?
No, that's it. Thanks for hanging out with us. We are off again next week, but we'll see you in 2 weeks.
All right. And again, please rate and review the podcast. Listener mail, always welcome. SkippyDougals@gmail.com. Have a good one, everybody.
Peace.